16th of November, so I hope everyone is well and had a good evening. Just having an overview then of what we're going to discuss the next 20 minutes or so. We'll have a look at some reports that have come out this morning in regards to the Brexit situation. There's a couple of things to be aware of. Have seen a little bit of movement in the pound, pretty early trade. We'll also have a look at the equity market. Although we've had a bit of a bounce yesterday in terms of the S&P finishing positive, obviously there still is almost a growing feeling that we are potentially seeing a little bit of a change in sentiment, generally speaking, about this ability of whether or not the market can continue to buy the dip kind of mantra. So we'll have a look at that, couple of graphics to share with you, and then we'll have a look at the day ahead as well. So looking at the charts firstly this morning, as I said, the pound did stick out a little bit more than the others when it first came in this morning. It doesn't look like a great deal of a move here when you look at it in the context of the last day or so. But what I'm looking at is this move here. This is when UK and European participants came into market. So came after a very quiet kind of Asia Pac session. It's quite typical. We're just very much gravitating toward that pivot level, but then a pretty decent run lower all the way down to pretty much the low print that was seen in yesterday morning and the prior days, what would have been the early Asia Pac session, and then yesterday morning when Europe came in. So sitting just above the S1 at the low. So first of all, reasoning for the move lower, and this was the story. It came out of the Politico. Now the Politico website is a subscription one, so it's locked up, but the general headline is that source reports from Politico as indicating the EU is said to reject UK bid for bespoke trade deal. And so obviously this is a net negative. Europe kind of playing a bit of a hard hand, obviously going into the EU summit, which, as we know, is pretty much 4 weeks to the date. So about 29 days away, actually. One of the main things then that we're looking at here is going back to the cable chart. So if I just shorten this down a little bit, you had the dip, and then actually we've recovered pretty much most of that to come back to around the initial lows that were defining the range from the overnight session in Asia, which is around 31.78. So a sharp recovery of a good 30 pips or so, and there was a little bit of reasoning behind that as well in terms of another article which is circulated this morning, which is in the Sun newspaper. So the Sun sources have said that Theresa May is preparing to offer up to £20 billion more to Brussels in the first week of December to kickstart Brexit talks, according to the Sun. Additional money would come on top of the 18 billion the Prime Minister said she would pay to secure a transitional deal in her Florence speech. So if you remember, they've kind of said 20 billion euros, or I guess 18 billion sterling, but she's got talking more around close to the 40 billion figure now. As we know, in terms of the different posts of the current negotiating stances, Europe has obviously come back down to about 60 billion. The figure on the table from the British side is at 20 or 18, and they're going to look at doubling that essentially. So timing of this is obviously makes sense from a tactical point of view. May probably likely, well, really two things. She wants to put this figure out there in the first week of December because the EU summit happens at the end of the second week of December. So again, you're showing a kind of an olive branch that you're willing to give a further concession. You know, it's not a small amount of money. You're doubling, in fact, your initial offer. Whether I think that the EU will accept that, I don't think so. I think they might still put the pressure on and look to acquire at least another 5 to 10 billion before we get to some sort of compromise, which it seems standing away from the day-to-day ebbs and flows of the negotiations. The fact that they started at 1 to 100 billion and it seems like they're going to meet at 50, it's kind of like, well, why didn't they just get on with it in the first place? But the reason for that, of course, is that it would be detrimental for Theresa May, already under pressure, if she was just to already just say, fine, Europe, have your 50 billion, because then she would most definitely face a cold from her kind of more hard Brexit type conservative members who would be like, why are you doing that? Why are you being so soft with your negotiation with Europe? And that would be would probably lead to her eventual demise. So this is the incremental approach, which is kind of the logical path of regular negotiation, I'd say. And whether or not this is enough for Europe to then want to push ahead and start to talk more and sign off this transitional deal, I'd probably sit on the side of the fence saying it's probably not enough, not yet. But certainly it's a step in the right direction, let's say, in order to safeguard Britain's short-term horizon. And so despite the Politico report, it's kind of been saved, if you like, by the fact that it seems that at number 10 movement is happening to up the figure. So I think with the pound in where we trade at the moment, we're probably going to sit back in this range now of around where we are, possibly up to pivot, but there is obviously an important piece of economic data coming out later. One of the main things in which we saw yesterday, of course, was, if I just broaden out my chart again, was that dip here. Now that was because the wage numbers, in fact, were slightly better than expected, but the market's more concerned about the bigger picture here, and that is the fact that we had wage data that was fairly stagnant overall, and of course the day prior, on Tuesday, we had UK CPI, which is still tracking at multi-year highs at 3%, and in fact they continue to remain a far gap between the cost of goods and therefore diminishing purchasing power, and households getting squeezed further with this negative real wage growth we have at the moment in Britain, and that's what's concerning. And so the actual dip was fairly large post those figures, and then we've dipped again on the Politico story. We've recovered, but today, of course, on the calendar, the thing which everyone's going to be looking for from the UK is how is the performance on the high street. Now this is also a very important figure, given we are a service sector driven economy, and also in the context of the fact that updates from the high street in the UK, whether from single companies or third party measurements of statistics, have been underwhelming, to say the least. Definitely retailers are very cautious going into this critical holiday season at the end of the year, and so it will be interesting to see how this has performed. Just looking at the numbers here, retail sales expected a plus 0.1, but if you remember, we had a negative 0.8 last time. If I quickly just jump on trading economics, let's get this up on a chart and we can have a bit of a more detailed look. So this was the previous retail sales number. It came out at minus 0.8% month on month. Expectations were for just a decline of 0.1, so it was very disappointing last time. Expectations are for a flat reading, so it'll be interesting to see whether or not that can materialize. But certainly, if that is negative and it does disappoint as it did last month in UK retail sales, then certainly the negatives are definitely stacking up. The only thing I guess that can mitigate a downturn in the pound is a positive development on the securing of a transitional deal, and certainly doubling the current figure might help. For the time being, it's going to be interesting though whether or not that comes to light. We'll have to wait and see, but we'll talk about that release as we get closer to it and some key levels to be on the lookout for. This is the other chart I wanted to show you. Just give me 1 second here. This is looking at the global index futures this morning. You can see that actually we closed positive last night in the S&P, so a decent bounce that was seen after the initial weakness that was apparent in the very early part of trade here in the SPOOs. If we look at the S&P on a longer dated chart, you can see why people were getting a little bit nervous about this profit taking after initial run up close to 2600, because we've had 3 real good tests of that 2562 level, which has defined much of the November support. We did break that at around the open, and I did see some pretty aggressive selling across the 3 major indices, but lo and behold, the so-coined plunge protection team came to the saviour of the equity market and rallied it all the way back up, and in Asia we bought it all following suit from the eventual positive close that we're seeing at the end of the session. Now, consequently, not a great deal going on overnight in Asia. There was some Aussie data, but it hasn't had a lasting impact on the local currency. But following this equity move, we've had a bit of a gap up in the DAX. So that entire price movement that was seen during the course of Wednesday, when we gapped lower and we found some resistance at that gapping price, you can see here how that worked out technically quite well on the recovery yesterday afternoon. When we did get that recovery in the US equity market after the open, the DAX just ran into resistance right at around that previous low that was seen, which would have been Tuesday's session. So likewise, I'd say that that's a pretty good area of support for the DAX for the moment, and obviously will need to be watched. Would be this 20 or this 12,997.5 level, and we found there close to a bit of support already for then a bit of a bounce back above the R1 this morning. So this is one of the charts I wanted to share with you, was a breakdown of the S&P 500 showing the week-long pattern. So this is actually the last week, and every single day for the last week's worth of trading sessions, we've sold off and rallied, sold off and rallied, sold off and rallied. Quite incredible, this buying the dip kind of idea. I guess from a more structural point of view, the global economy is improving. I'd say on balance, US economic data does reflect that specifically. We've had generally a very good earnings season. Now that's kind of passed. Obviously, there are though flip side arguments. We've had a lot of toing and froing on the tax reform bill, which ultimately looks like it's going to take some time before it can be fully finalized and then implemented. And then also you've had the flattening of the yield curve, which sometimes serves as a precursor to an economic downturn. Last time it was kind of at these levels, really you're going back to 2007, which was obviously the period before then the financial crisis. And there are then a few things to look at. Although this remains definitely a trend to be aware of, I think personally, much like things like Bitcoin, the more people talk about it, the more it makes me a little bit nervous that at some point you're going to hit this kind of top of the market, and whether or not this can continue to happen is going to be interesting. I think it's right on the balance at the moment, because this is suggesting that investors are willing still, on the baseline fundamentals, that they're confident that the market should remain supportive, and actually this is just, as we discussed before, a function of a minor correction for the next necessary to occur in order for another push to the upside. However, I did see this, and I quite like this as a list of top 10 reasons to worry, not to spook people too much. But there's a couple of stats here that I quite liked about the S&P. And I know Charlie shared a graphic with me this morning, and it was saying that basically on a total return basis, the S&P 500 has been up for 12 months in a row. Now, I'm trying to look at the stats this morning. I can't ever remember it being up 12 months in a row. Certainly there's usually a period of where it's either flat or there's at least a negative performance, but that hasn't occurred in a year now. The yield curve, as I said, is the flattest it's been since 2007. The S&P 500 hasn't closed lower by 0.5% or more for 50 consecutive trading days. That's the longest streak now since 1968. The S&P has not finished red 3 days in a row for more than 3 months, the longest streak in 7 years. So, I don't want to frighten you, but traditional patterns would suggest that this cannot last forever, and almost the longer it goes on, then logic would tell you that at some point we're going to hit this kind of point where then you'll have a sudden move. Now, whether or not that's today or this week is definitely yet to be seen. But yeah, certainly I think we're getting very close to this point of where either we have a very decent strong push to 2600 in the S&P in a pretty quick fashion. We're trading 25.72 this morning, or we do get this decent pullback and we start to see one of the bigger corrections that we've had, certainly in the last year or so. I mean, looking at the S&P here on a daily continuation, should we failed to break it yesterday, although we did briefly flirt beneath that level of 62. You can see it's provided support again this morning, so it is a critical level. Push beyond there though, if we started to see a decent move downwards, 25.41.5 definitely would be a first target to be looked at. I mean, if we were looking at it as a percentage change, that's only 0.78%. The next levels beyond there, probably the 2500 level. So just looking at what that would be percentage-wise is about a 2.5% or so correction. And then beyond there, then you've got that peak that we saw in the summer period and some of that consolidation around September. That would be about a 2.8% correction. Even then, I mean, if you start zooming out of the S&P chart, let's say we did correct that much. I mean, just check out how much of a correction that would be. I mean, it's not exactly a mammoth move to the downside. So I definitely think that if this market did decide to really see some decent consecutive downward moves, even if we came back to 2500, I'd still actually feel more favorable of the long at that point. So buying the dip just becomes buying the dip but at a much lower level, because beyond here, I mean, you're pretty much looking at psychological handles beyond there. I mean, you can see how well they've really played out. The 2400, you can see from here, beginning of 2017, you then had the summer support point, all at that psychological level. 2300, again, likewise, around these price points here, from when you had the initial test and break, and then the support thereafter. It's a pretty constant theme, really, because we've been at these record levels. Now, again, this is looking distinctly Bitcoinish, which is, from a behavioural point of view, I think is definitely a point for consideration in terms of how the market tends to function when it's certainly trading at all-time record high levels, when there isn't historical precedence for previous price points up at these elevated levels. So what I'm saying is that I don't actually think that we're going to sell off anytime soon, but if we did, I don't think it would surprise me a great deal. And if we did, then I'd be looking for a concerted pullback of a decent move down to the 2500 mark would be the ultimate target. Before then, the market stabilizing and then potentially moving back to highs again would be my kind of longer term call on it. All right. A few other things to have a quick look at. We did briefly speak about this yesterday, and it's getting a little bit more airplay, and this all comes down to the fact that basically Angela Merkel has put a self-imposed deadline on herself to cob together this coalition, this Jamaican coalition with the FDP and the Green parties. So if she cannot secure this, obviously she can roll her deadline. It's not a definitive formal deadline, it's just something she said she would look to have it done by this point. But what it does mean that if she does fail to secure a coalition more longer term over the coming weeks, then she can either try to govern as a minority government, which obviously comes with huge complication because it means that every time you try to push through a proposal or reform, whatever it might be in the Bundestag, is going to get voted against. And so it means that really you are a very highly ineffective government. Or you get an election repeat, which is actually a viable possibility and definitely would be more troubling because it tends to then lead to more political uncertainty going forward, and who knows how she would perform this latest time round, particularly given the resurgence of the far-right party, the AfD. So something, again, just to be aware of and monitor in the background. Okay, finishing off, having a quick look at the calendar. So as I mentioned, we'll have another in-depth look at, in about 20 minutes or so, the UK retail sales report. So that's coming out past. These sterling traders, you want to be watching that for sure. Going forward, you then get the October Eurozone inflation figures, but keep in mind these are final prints for October, so not really expecting too much of a reaction to that. But going into the US afternoon, you get your regular weekly jobless claims. You also get Philly Fed, which sometimes can be quite interesting, but I would say on the balance, nothing really here, because you've got US IP and cap utilization, NAHB housing market index. Nothing here is, I don't think, going to be too much of a game changer for Fed thinking for December and beyond, and so consequently market impact to economic data points might be minimal. I would say it's more going to be tracking of key technical levels and general sentiment derived from a lot of people now, of course, as we discussed, talking about the equity market between buying the dip or the stacking up of worrying statistics about how we are due a correction. So equities, I think sentiment around the cash open at 230 will be quite important. Then obviously any updates on the tax plan and also anything further on the sun sources that we've had this morning about the upping of the Brexit bill. So I guess the way to factor that in if you were trading the sterling currency is that if you look at where we are in the pound, we have, as we said, exactly recovered back to the pivot point from where we were as a kind of average price point from overnight Asia Pac session and much of yesterday. So we know now then that the market's kind of priced in 40 billion. So the key now is when it officially comes, whenever that might be, does Theresa May go to 30 billion? That would be a disappointment and the pound would likely sell off. Does she go to 50 billion? The pound would probably aggressively rally because Europe are probably being more incentivized to take that offer, and that will secure the transitional deal and then safeguard the outlook, at least for the near-term horizon, to commence trade talks. So that's kind of how I would tackle that news flow if and when it comes. Okay, that's it. So have a good day. As per usual, any questions, just let me know in the chat room. Happy to help. Thank you very much.